Hello, and welcome to this lecture on the money supply. In this class, we will discuss what the money supply is and how it is measured. We will introduce two ideas about the money supply. First, the money multiplier. Second, the quantity theory of money. These ideas connect the money supply with important economic outcomes, including inflation. If central banks aim to target inflation, then targeting the money supply can make sense. We will discuss how central banks control the money supply. Let's get started. Money is what we use when we buy and sell things. Broadly speaking, it is a reliable means of payment between a buyer and a seller. The money supply is the amount of money in circulation. The money supply includes dollar notes and coins, but it can also include other items as well. Let's be more precise about how we measure the money supply. The narrowest definition is the monetary base. The monetary base includes the amount of currency in circulation. It also includes bank reserve balances. These are deposits held by banks in their accounts at the Federal Reserve. A somewhat wider definition of money supply is M1. M1 starts with the monetary base. We then add on transaction deposits. These include our checking account balances at banks. The idea of M1 is to capture cash and also how many loanable funds banks have. These are funds that banks have available to lend out. But why are loanable funds so important? And how do they relate to the money supply? Consider the following example. Let's say you deposit $100 at your bank. The bank keeps 10% or $10 at the Federal Reserve as a reserve. This could be required or simply prudence on the part of the bank. It lends out the remaining $90. The $90 will appear as a new deposit in the borrower's checking account. Again, the bank keeps 10% or $9 at the Federal Reserve as a reserve and lends out 81. Now, the 81 will appear as a new deposit. This process could continue on and on. It is often called the money multiplier. Each time funds are loaned out, bank deposits and therefore the money supply will increase. In fact, the 10% reserve is what limits the money supply. Let's look at two more measures of money supply. The most common definition is M2. This is M1 plus other items that can be converted into cash at a relatively short notice. This includes savings deposits, small time deposits under $100,000, and retail money market mutual fund shares. The widest definition is M3. This takes M2 and adds large time deposits, institutional money market funds, short-term repurchase agreements, and larger liquid assets. Historically, measures of the money supply were closely related to key macroeconomic outcomes. Past episodes of high inflation coincide with periods when the money supply has grown fast. Why? Well, like any other commodity, the value of money declines if there is excess money in circulation. The relationship between money supply, inflation, and economic growth is called the quantity theory of money. It is one of the oldest ideas in economics and was popularized by Milton Friedman of the University of Chicago. Why does this relationship matter? Well, central banks target stable prices and maximum employment. This is their mandate. Historically, measures of the money supply were closely related to inflation and economic growth. For this reason, central banks have used measures of the money supply when deciding on monetary policy. Let's take a look at this in the data. This is the US context going back to the 1960s. Here we have the M3 money supply. Now we add the consumer price index to measure inflation. You can see that M3 money supply tracks inflation reasonably well, though there is some divergence after the recession in the 1980s. Similarly, M3 tracks nominal gross domestic product well through until 2000. So, in principle, the Federal Reserve could control the money supply to achieve its mandate. In practice, they could also do this by targeting banks in a couple of ways. First, the Federal Reserve can change the reserve requirement for banks. Recall the money multiplier? The higher the reserve requirement is, the more reserves banks must hold and the less loans banks can make. In other words, the Federal Reserve can control the money multiplier. Second, the Federal Reserve can conduct open market operations. In open market operations, the Fed trades securities with banks, treasuries for example. If the Federal Reserve sells securities to a bank, the bank must pay the Fed using loanable funds. As a result, the bank will have fewer funds to make loans, which will decrease the money multiplier and the money supply. Are we done? Not quite. Unfortunately, as time went on, the relationship between money supply, inflation, and GDP became less reliable in the data. First, there are now new payment technologies and ways for households to store cash. This made it harder to measure money supply. The Federal Reserve has stopped circulating M3. Second, the relationship between M3 and inflation or GDP have not been stable since the year 2000. Since the financial crisis of 2008, the relationship between M3 and GDP has broken down. You can see the clear divergence here. It happened again during the COVID-19 pandemic. Most central banks now regard money supply measures as less important when making monetary policy decisions. In this session, we have discussed the concept of the money supply and its connection with monetary policies. The key takeaways are: first, we can measure the money supply several ways. We discussed the monetary base, M1, M2, and M3. Second, the money multiplier connects bank reserves with the money supply. Third, we examined the relationship between money supply, inflation, and GDP. Fourth, we saw that monetary policy can increase or decrease the money supply.